Have you ever wondered how a faraway naval patrol in the Persian Gulf could actually affect the price of your morning coffee? It sounds disconnected, but the truth is, the world of geopolitics and your personal finances are linked in ways you might not expect. When tensions rise in the Middle East, it's not just a headline. It's a signal that can send shockwaves through the global economy, right down to your bank account. From the cost of oil to the interest rate on your mortgage, these distant events have a very real, very direct impact. So, how does it all work? Let's break it down. First, why does this one region have so much power over the global economy? The answer is simple: energy. The Persian Gulf is the world's energy superhighway. A massive portion of the world's oil supply travels through a tiny choke point called the Strait of Hormuz. Imagine a single, narrow doorway through which a huge crowd must pass. Now, what happens if that doorway gets blocked? Even the threat of a disruption, like a military conflict or a political standoff, can cause chaos. Global supply lines are immediately at risk. This uncertainty sends energy traders into a frenzy. The price of oil doesn't just rise, it skyrockets. The word that defines this entire situation is volatility. The market hates uncertainty, and when the world's most critical energy route is in question, volatility becomes the new normal. This spike in oil prices triggers an immediate chain reaction that leads directly to inflation. Think of it this way: that barrel of crude oil is the first domino. It directly affects the price you pay at the gas pump. Suddenly, filling up your car costs a lot more. But it doesn't stop there. Higher fuel costs mean it's more expensive for trucks to transport goods across the country. Those trucks deliver raw materials to factories and finished products to stores. Factories now face higher energy and transportation bills, so their production costs go up. To stay profitable, they have to charge more for their products. That cost gets passed on to the supermarkets and retailers you shop at. Suddenly, the price of everyday items like milk, bread, and vegetables starts to climb. What began as a distant geopolitical event has now shown up on your grocery receipt. This widespread increase in prices across the economy is what we call inflation, and it directly shrinks the purchasing power of your money. Now, how do the world's financial leaders respond to this rising inflation? This is where interest rates come into play. Central banks, like the Federal Reserve in the United States, have a primary mission: keep inflation under control. When inflation gets too high, their main tool is to raise interest rates. Or in this case, keep them high instead of cutting them. The thinking is that, by making it more expensive to borrow money, they can cool down the economy and slow down price increases. But this has major consequences for you. If you're looking to buy a house, a high interest rate environment means your mortgage will be significantly more expensive, potentially putting homeownership out of reach. For business owners, higher rates make it harder to get loans for expansion, new equipment, or hiring. This can lead to a slowdown in business investment and economic growth. Essentially, the central bank's fight against inflation, which was caused by the oil price shock, ends up making borrowing more expensive for everyone. So, how does the stock market react to all this? With a lot of anxiety, markets are forward-looking and they see this chain of events unfolding. Geopolitical tension, higher oil prices, rising inflation, and high interest rates. This combination is toxic for many parts of the market. You'll see a sea of red in sectors that rely on consumer spending and business growth, like technology and retail, because higher costs and interest rates squeeze their profits. However, not everything suffers. The energy sector itself often thrives, with oil and gas company stocks glowing bright green as their revenues soar. In this environment of fear, investors often flee to what they call defensive assets. These are investments perceived as safe havens. During turbulent times, like gold or government bonds, the market's fear gauge, known as the VIX or volatility index, will often spike, reflecting the high level of uncertainty. Smart investors don't panic. They start to rebalance their portfolios, adjusting their strategy to navigate the stormy financial seas created by a crisis happening thousands of miles away. Let's bring this all back home. How does this interconnected web of events tangibly affect your daily life and your household budget? It starts with the obvious: your car. You'll notice the fuel gauge seems to drop faster simply because each gallon costs more. That sting you feel at the gas pump is the first direct hit. Next, you'll see it in your utility bills. The cost to heat your home in the winter or cool it in the summer will rise because electricity generation often relies on natural gas, whose price is linked to oil. Then comes the grocery store. Your usual shopping cart might look a little less full for the same amount of money. You might find yourself making tougher choices, maybe putting an item back on the shelf. This financial pressure can lead to higher credit card balances as you struggle to cover rising expenses. Your savings can take a hit, as money that would normally go into a piggy bank or a savings account is now being used just to get by. These pressures culminate in serious conversations around the kitchen table, spreading out bills and trying to figure out how to make it all work. It's a powerful reminder that an event in the Persian Gulf is directly connected to the financial well-being of a family living continents away. So, what can we do? It's easy to feel powerless, but the key isn't to predict the future, it's to prepare for it. Let's think in terms of scenarios. In one scenario, diplomats reach an agreement and the tension subsides. Oil prices might see a brief spike but would quickly return to normal. The economic impact would be minimal. But in another scenario, a prolonged conflict or standoff could lead to a long period of high, sustained oil prices. This would create lasting uncertainty in the market and a much more severe economic impact. Since we can't know which path events will take, we need to shift our focus from prediction to preparedness. This means building a resilient financial plan. Diversifying your investments across different asset classes can help cushion the blow if one sector gets hit hard. Building a robust emergency savings fund provides a critical buffer to cover unexpected expenses without going into debt. It's about creating a personal financial toolkit that allows you to weather any storm, whether it's a job loss, a medical emergency, or a geopolitical crisis. In the end, we live in a deeply interconnected world. A single event can create ripples that spread across the globe, from geopolitical hotspots to the world's major financial centers, and eventually, right into our own homes. The journey from a news headline on your phone to your monthly budget is shorter than you think. But understanding these connections is the first step toward empowerment. When you see a news story about tensions in the Middle East, you'll no longer see it as a distant problem. You'll see it for what it is, a potential signal for what has to come in the economy and for your own finances. By being informed and prepared, you can move from a position of worry to one of thoughtful action. That single drop of oil creates a ripple effect. But by understanding its journey, you can ensure that when those ripples reach your shore, you're ready for them. Thanks for watching. If you found this helpful, please like, subscribe, and share it with someone who might need to hear it.